Hi everybody, Mike McKay here. Happy New Year, it's 2019. This video is to help people who have small businesses learn about the tax changes that will be affecting them this year. It's right around Chinese New Year, and it's the year of the boar. And the year of the boar means there's some stable things going on, but many small business owners will need to understand that 2019 is the year of the tax. The federal government has introduced a couple big changes that will affect you and your taxation level, but generally the amount of tax you're going to pay if you're a successful small business owner or a medical professional with a Prof Corps, you are going to pay increased corporate tax this year. There's a small bit of good news. I'll break that down first. First of all, the federal government has reduced the small business tax rate by 1%. So in Saskatchewan, on your first $500,000 worth of income, instead of paying 12% corporate tax, you'll pay 11%. So that's an approximate decrease of about $5,000 on your first $500,000. That's the good news. The bad news is the federal government has started a program called the Small Business Clawback. And essentially the Small Business Clawback is to deter business owners from leaving assets inside their corporation for a long period of time. Now, if you've had a small business or a Prof Corp over the years, your tax planner, your accountant has probably suggested to you to retain earnings in your corporation to delay paying that tax burden until a time when you need to take money out of your corporation in your retirement. So if you've been a successful small business owner, you've been a physician for a long time, you probably have assets retained in your corporation that are sitting there as an investment. Now, returns on that investment is called passive income. And what the federal government is doing is creating a situation where if you have substantial passive income on your investments, that you will lose your small business deduction and you will pay your corporate tax rate at the general rate. So here's how it breaks down. Once you have $50,000 worth of income from your passive investments, which is only a 10% return on $500,000, okay? Your small business rate of that 11% that I mentioned will begin to be clawed back so that eventually you will pay 27% corporate tax once you have $150,000 worth of passive income on your investments. So imagine a $1.5 million portfolio making a 10% return, and that will be $150,000 worth of passive income. All of a sudden, what will happen is instead of paying 11% on your first $500,000 worth of income, you will now lose that small business rate, and it will slowly move up from 11% to 27%. Okay, so what does that mean? Well, you can imagine a 27% tax rate. That's an additional $70,000 of corporate tax that you will pay if you have a nest egg there in your corporation earning good passive income. $70,000 of extra corporate tax for my medical professionals, that represents between 1 and 2 months of work that you'll go to work, you'll go to the hospital every single day, and all that income will simply go to corporate tax. So it is a substantial difference. If you're a business owner, the numbers still apply, but essentially many more of your days, working days of the year, are going to be going completely to corporate tax. So what can you do? Well, there's several things that you can do, but you need to talk to a tax planner. It breaks down into 2 different categories. One is that you can tax shelter those investments in your corporation. There's a couple of strategies to do that. The biggest one would be invest in something called a corporate estate bond, which is a tax sheltered investment inside your corporation. The other strategies involve pulling money out of your corporation, not in retirement, but pull them out in a tax advantaged way. And there's a couple strategies there, but essentially what you want to do is make sure that you're pulling assets out and creating tax deductions to offset that income tax that you'll have to pay to pull the money out. So it's important that you dig deeper and you talk to a tax professional and you do it quickly, because you can't wait all year for these changes to impact you. $70,000 worth of extra tax that you're going to pay in your corporation is a sickening amount. But there's things you can do to fix that and change that situation. I urge you to reach out to your tax professional, to us at Precedence Private Wealth, so that we can help you really change your retirement and not be buried under these new tax changes. Anyway, thanks. I hope this has been of value. We'll talk to you soon.